From the morning reading, Spider, QQQ, Diamonds, gain for the 6th week. Financials, energy, tech lead for the week. Monster gap up on Friday. VIX closes down. 4 sectors moved higher on Friday. XLF, XLK, and XLB were the strongest sectors, while XLU was the weakest sector. For the week, 7 sectors moved higher, led by XLF, XLE, and XLK, while XLP and XLU finished lower. Breadth weakened on the New York Stock Exchange as decliners led advancers 1.61 to 1, and on the NASDAQ it strengthened as advancers led decliners 1.58 to 1. Strong jobs report pushes bond yields and dollar higher. Rising dollar may be helping small caps to play catch-up. Rising rates help banks, brokers, and insurers, but hurt utilities and REITs. Rising bond yields favor cyclicals over staples. Dollar surge to 7-month high hurts commodities. It also increases the need to use currency-hedged foreign stock ETFs. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:16 a.m. Central Time, and I'm recording this in preparation for the market day of November the 9th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's take a look at our morning report. In general, all 4 broad market indices are negative, with the S&P down about 6 points on the futures, or about 1/3%. Russell down about 0.2, NASDAQ down about 0.4, and the Dow down about 1/4%. Crude oil's up about 1.4%, Euro's up about 1/3%, bonds down just marginally, and gold is up about 0.5%. Mixed action overseas. In China, up about 1.5%, Hong Kong down over 0.5%, Japan up almost 2%. Germany is down about 1/3%. United Kingdom is scratch. In terms of macroeconomic reports for today in the U.S., really nothing of note. For tomorrow, we have import prices, mortgage delinquencies. There is a 10-year bond auction if you're in the bond market. And that's about it. So the beginning of this week is relatively weak. In terms of volatility, we have short-term VIX down to a 12.6, so getting pretty low there. Skew continues to remain elevated. IV percentiles very, very low, down to a 6 on the S&P, 14 on the Russell, 11 on the NASDAQ, and 14 on the Dow. No standard deviation moves were put in on any of the broad market indices on Friday, and actually you have to go back 5 trading days before the last one, and we're down to only 2 standard deviation moves in the last 2 trading weeks on the S&P. So things have definitely started to get much, much quieter. And there's a couple ways you could take that. Reversion to the mean. You get quiet, that means volatility is priming to come back. But also keep in mind that the other opinion is that things can get quiet and stay quiet for prolonged periods of time. So just because things are low doesn't mean that they're about to explode. Obviously, eventually volatility will come back, but doesn't necessarily mean tomorrow. In terms of the charts, we've had pretty much a classic rollover. You saw after we'd gone through this whole series of patterns, we've been talking about these bull flags as we ran into various levels of resistance in this huge move, biggest move in 4 years for that amount of time. Coming up about 250 points. But then we came up, we had a bearish engulfing, confirmation, and then kind of an interesting lower wick here on Friday's action. So we'll have to see where that goes. Is this it for the bull flag, and we now get a trigger and breakout to leg up, probably to the former all-time high area. If we do get that break up on the bull flag trigger, or is this bull flag still got a little bit more going for it and we'll see continued weakness? Now, as of early this morning, it would seem that we're going to come down and still have a little bit of weakness and certainly not be triggering immediately. Also notice our indicator, the PSAR here, has flipped negative, so this could be a little bit more weakness coming in here. It'll be interesting to see just where this goes, because we are kind of in this transition where we're back to the former range. Our short to intermediate term time frames are bullish, but our longer term time frame has a mixed cast to it and is a bit more bearish, and what we would call neutral bear. And so which time frame is going to trump, the short and medium or the longer term, and which way does this thing eventually go? Or a third option, as I discussed with some traders last night, is that it just stays sideways and we could go back into a pattern much like we had earlier in the year with a range, and we just chatter back and forth within that range and don't really exhibit bullish or bearish patterns. That can be traded. There's a number of strategies, of course, that can make good use of that. Though for the buy and hold crowd, that can be quite frustrating because you don't ever see follow through to your targets. At the same time, you don't actually take much, much heat, as it were. You just kind of churn around in a sideways pattern. So the Russell, interesting though, on Friday, Russell broke out of this 2-month ago FOMC wick area and the recent days tops, and confirmed a breakout there. So we'll be interested, very interested to see if this plays some catch up and gets back up into this former range, which to catch up with the SPX and the NASDAQ needs to be up in this relative area. So quite a bit of room to go for the Russell, but did some good things on Friday. In terms of the NASDAQ, we have had those new 52-week highs come in, but also had something of a rollover pattern and looked to be in something of a bull flag there as well. So we'll see if it does like the S&P and continues weakness, or does it trigger that bull flag and make some new highs. On the Dow, also kind of a rollover pattern here. Not quite as clean a rollover pattern as you had with the S&P. With the S&P, you recall we had the bearish engulfing here. We have dark cloud cover with confirmation, and then just kind of a continuation at this point of the bull flag. We'll need to get a little bit higher price action than this top of this candle to be able to trigger this bull flag, and obviously just a little bit beyond there you would trigger a horizontal breakout as well. So number of interesting things going on there. Let's go to our daily report. In terms of our market trend, intermediate term phase opinion, we're still phase 3, indeed looking for those bull flags. In general, expecting relatively shallow pullbacks and then longer bull runs until proven otherwise. Overall, the portfolio investor posture, IBD status, remains in confirmed uptrend. Accumulation distribution score for the S&P chart is a B, NASDAQ a C. Continue to have breadth concerns with the NASDAQ. GMI index is 6 out of 6 with a buy signal since 1019, though that author remains in cash due to the orientation of key moving average lines, and that is in a similar system to what we use here in this primary market condition, neutral bear. And that's that longer term time frame is not bullish. So that's something you have to keep in mind. In terms of the decision point scoreboards, short terms are all up, intermediate terms are virtually all up, and we're starting to see some signals come in to the long term to also turn up. So that situation here with this neutral bear continues to heal incrementally, and right now the bias is, if we put all this and make a consensus of these various mechanical signals, the bias is that we are in a transition phase, but with a fairly strong bias to the bull side. Intermediate term market posture is very bullish posture with an upslope sentiment. Indeed, all four indices are up over 95, so very, very bullish posture there on the intermediate term. Position sizing opinions on both systems are calling for 100%. In terms of hedge warning status, 0 plus, normal with some elevated risk aspects. No change there. And this actually, if we make it to the end of this week, that will be the longest period in 2015 that we have held with an IBD status of confirmed uptrend. So it'll be interesting to see if not only do we extend that period, but do we actually achieve something in terms of that we actually start to have real gains and not just kind of this sideways action like we had earlier in the year. In terms of the various lower metrics on the volatility base, you see pretty much all okay all the way across. You do have this elevated skew, but that's been present now for several weeks and hasn't really produced anything as of yet, but that is a warning sign there. Notice the New York high, new low, basically benign, both of them close to the 300 mark, closer to the 300 on the new lows than on the new highs, but very, very mixed kind of action there on Friday. All 5 key intermarket risk aversion indicators are risk on and solidly so. In terms of special opinions, option income strategies, VIX is inside the acceptable window to initiate new trades. Just kind of keep in mind that your strategy selection will benefit if you take a strategy that benefits from an increasing vega. At some point, this low volatility will increase, and you could take advantage of that as a secondary aspect of your design selection. In terms of covered call strategies and put selling, conditions are cautiously bullish, acceptable to initiate new positions. For the covered calls, use that 1-to-1 ratio of out of the money, in the money strikes, so a little bit defensive still there. Also, in terms of the selection of higher beta and lower beta, also a 1-to-1 ratio. On those more aggressive setups, consider legging in through an out of the money put. Also, consider scaling into a full position, especially since we're kind of extended at this point, and pot odds are that there's not as much room to the upside before we run into significant resistance than there is to have room for a bit of a retracement. So be careful about initiating positions at this area. But that being said, if you have a good solid chart, use some metrics here to kind of design the way you play that to be able to have some defensiveness to it, but it's still, these are good conditions, and you have to be able to put on positions when you have this kind of a bullish market. In terms of sector specific, all 3 time frames in fairly good shape. You see the consumer staples and the utilities are the 2 weakest sectors. Keep that in mind. In terms of percent change, you see financials had a good day on Friday, as you would expect, with the expected move by the Fed with interest rates. That is a reflection of what happened with the employment report from Friday morning. So financials would be a big winner if that were to start to happen. At the other end of it, you see utilities got hammered, and they would not be a beneficiary of increasing interest rates. Utility companies have large debt loads, also depend on their ability to pay dividends, and those dividend yields would be less valuable if the bond yields, start, making changes as a result of those interest rate changes by the Fed. So let's see here. I think that's probably enough for today. Um, as always, you can find our blog here at this address on social media. You can retweet us to your Twitter followers, to your StockTwit followers. You can find us on Scootify and StockTwit. Here are the handles. YouTube, hey, subscribe to the channel. That way you'll get notice when we post new content. And then also, all of these are in effect an acknowledgement that what you have found here has been helpful to your trading and you want to let others know about it. We take note of that, and that encourages us to continue to put in the time and effort to provide this free market commentary to you each morning. Direct email support at falconglobaltraders.com. And there are a couple special opportunities available to kind of keep in mind right now. One in particular is we're on the final approach, as it were, to taking our cover call mastery course public. So we are taking names of people who are interested in this. No obligation, or just send me an email at steven@falconglobaltraders.com to express that you would have a potential interest in this course. And as we get that put together, we will send you the details and on that course as that comes together. I expect to offer that in early 2016. This will be a very comprehensive course. This is not one of those little freebies that you can get from various places about cover calls and you get 15 minutes or something. This will be a very comprehensive, complete rules-based trading system, A to Z. Likely will be an 8 to 10 week course. It'll be available for both in-person and virtual attendees. So if you ever thought that you'd like to learn more about applying covered calls in a very systematic and rules-based strategy approach, this will absolutely take you there. Disclaimers as always. Hit the pause button if you need more time to review the disclaimers. And we'll see you back here tomorrow morning for the market preview from Falcon Global. Good trading.